They built a glass paradise way too high, then the bubble pop. The silent sound of foreclosure signs are all over town. I got a bad loan, a promise they believe. Now the dream is over, they're feeling deceived. I watch from the sidelines, patient and cool, playing by a different set of rules. All I wanna do is, and I wanna do is take the window. All I wanna do is, and I'll cash up hard and watch the funds grow. This is straight up capitalism, chip, chip, boom. Sweeping up the pieces with the concrete boom. Wanna do, wanna do, wanna do. Get a call from my contact, a whisper on the phone. Another empty unit, the speculator is gone. He says a shame with a crocodile tear as he sells me their future for a fraction of last year. The paperwork's easy, a cash only deal. That heartbreak and panic is my next big steal. They get a cardboard box, I get the ocean view. It's nothing personal, it's just what I do. And a casual body, take your condo. And a casual body, and watch the dance floor. This is straight up capitalism, chick, chick, boom. Sweeping up the pieces with the concrete boom. When I do wrong, when I do wrong, when I do. Some myself ask for a quick return. Some I rent out, let the lesson burn. They call it a crisis, I call it a sale. In this concrete jungle, the strongest prevail. No funny business, I am the business. They sold you a lead, I now I'm the witness. Seek your condo. Seek your condo. Watch the funds grow. Watch the funds grow.
Happy Thursday, Miami. This is Peter Zalewski. I'm a condo consultant. I'm also the founder of the Miami Condo Investing Club. If it's Thursday, going forward at 4 o'clock South Florida time, that means we're going to be talking distressed real estate in the Tri-County South Florida area of Miami-Dade, Broward, Palm Beach County. This week, for our premiere episode of the podcast, we have a veteran distressed real estate buyer. We have somebody who basically is, he's a trader. He likes to play the arbitrage market. He looks for deals. He then looks for an ability to get out. People who buy from him, they make money. He makes money. Everybody's happy except the people selling. Who is it? It's no one else but Jose Suarez. Jose is a real estate investor. He's a house flipper. He's anything to do with real estate. He actually was a land trader as well. He owned a bunch of dirt out on the west coast of Florida. And now he's joining us for our podcast. Jose, his company is called Global Inventory Liquidators. Jose, welcome to the premiere episode of Condo Capitalism.
Excellent. I feel privileged to be in this premiere episode. Happy to be here and discuss today's distress market. Like Peter said, I'm a veteran in the business, been doing this since 1996. So I've seen a lot of changes in the market. It's always changing. It's always different. It's always interesting.
Well, Jose, it's great to have you on here. Let me sort of lay out the rules of engagement for our first episode. Okay. You and I are going to have a conversation for roughly about ballpark an hour or so. I know you tend to go on a little bit long, so maybe it might go a little bit longer. But basically, within that 1 hour window, what we're going to do is we're going to kind of talk about the general. We'll talk a little bit about your background, give people an idea of your credibility, your street cred, if you will. Then we'll kind of talk about what you're seeing. And then in the second half, we're going to actually get into numbers. And the numbers are surprising. I've been tracking the distressed real estate market for quite some time, actually for 20 years. I haven't looked at it recently, and I just pulled up some numbers yesterday in anticipation of this conversation. And what I can tell you, Jose, is it looks like bank-owned condos REOs, real estate owned, however you want to call them, it looks like the number is ticking up close to 400 properties in the Tri-County, South Florida area. Now, while that doesn't sound like a lot when you got 26,000 condos available in the overall market thus far, it used to be under 100. So we're seeing something happening, and I want to get into the details with you. And I also want to talk about pricing. Jose, when's the last time you saw a condo trading with a price that starts with a 2? We're talking 200,000-ish a door. When's the last time you saw that?
It's not very common, especially in the east of I-95 areas. That's very rare. So if you're starting to see that, that's definitely an indicator of what's going on. Yeah.
You know, Jose, one of the things that's come as a result of the Surfside condo collapse back in June of 2021, insurance industries, they basically lobbied, I would argue, the legislature as well as the governor, and they said, hey, listen, if you want us to insure these buildings, we have to make sure what we're insuring, we actually understand what they are. And as a result of that, there's been a bunch of legislation put in place, some of it administrative, going after the condo board members, forcing them now, when they find out what's wrong with a building, they actually earmark cash, put it aside so they can collect it, and ultimately they can do what's necessary, because back in the day you used to be able to defer it. And that is what's blamed for the Surfside collapse, simply people knowing what the issue was but not being able to come up with the money, or not wanting to come up with the money, kind of make the fixes. So, you know, there's been some changes. They got something called a structural integrity reserve study now, which is required every 10 years. Basically, it's an eyeball exam. You go in there, you get an idea, what's the status of everything. Then as part of the study, they do a financial calculation to figure out what it's going to cost, what's the shelf life of all of the critical factors. And then the association is given that report. They have to collect cash, and then they have to start to move forward to implement it. And then at year 30, they have to do something that's a little bit more thorough. It's called a milestone inspection or a milestone study. And as part of this milestone study at year 30, you're talking about a big hit on condos special assessments, most likely. Keeping in mind, special assessment is something you didn't budget for. Maybe it's like you run your household, and lo and behold, your car breaks down. That would be a special assessment where you suddenly got to come up with some extra cash. Jose, you know, you play in the condo game. You're buying some units, and don't give out too many details right now, but you're buying some units, and some of these units you're buying from people. Are these inspections and these special assessments and all of this stuff, is it factoring in as to why people are selling at deep discounts to you right now as we sit here at the beginning of the winter buying season in 2025, 2026?
Well, in full disclosure, I would say I don't traditionally seek out condos as far as my fix and flip deals. I have acquired 3 of them in the last, let's say, 3 months, not by choice. It's just by the numbers were so good and the opportunities were good that it forced me to look at condos because of the deals. But traditionally, either if you're buying in the foreclosure auctions, etc., you already have to do a lot of due diligence for the property. And then when you add in the condo factor for the short period of time that you have to analyze, most investors will stay away from the condos because of the uncertainties. Can you rent the first year? All these other factors that you just mentioned. So, but that being said, I've picked up 3 of them in the last 3 months, only because the opportunities were so good due to their assessments went up, you know, things like that the people were just trying to get out of it. And I pretty much stole these, and that's why I bought them. So they actually,
now legally you stole them. You stole them price wise. You didn't steal them like you put a gun to somebody's head or threatened them.
Correct. Legally, I just got, the deal was so good that I couldn't turn it away. So, and those I'm deciding to, you know, for better or for worse, I'm deciding, because the cash flow is so good and everything, I'm deciding to keep them and rent them. Now I'm getting into the problem, but you know, then there's then there's how do you exit? You know, are there going to be special assessments? Can I get financing for a buyer if I decide to sell? But that's I'm learning that as I go. So the bottom line is the opportunity has been so good buying them that I figured I'll figure out and I'll become a specialist on this, on the exit side.
Now, do not talk about pricing. Anybody who's watching this podcast, I'm going to ask Jose the prices going forward, but I want you to stick around for a little bit because we've got a lot of important things to say, and we're going to kind of keep you on the hook with that one. So we're going to keep you on the hook with the data. We're going to keep you on the hook on the pricing. But trust me, when I say Jose, who's a little bit on the cheap side, when he's saying it's a deal, pound the table, it is a deal. Jose, let me give you some data that just came out recently. We've been doing a number of reports, and I want to get your feedback on that. And then after that, we'll go a little bit into your background. Okay, does that sound fair?
Sounds good.
Okay, so just some key points that have come out recently. There's a property management company called First Service Residential. For the second annual year, they've come out with a report called the Benchmark Report. We've written about it. Anybody wants to see that, go to miamicondo.club, miamicondo.club. If you're not a club member, you're going to get hit with a paywall. If you join the club, you'll be able to get access to that. You also get access to our monthly meetings where I lay everything out as to what just happened. I gave you an idea of marching orders going forward, what to expect. And then once a month, we also do a meetup where people are able to get together. They're able to talk shop. We rotate the location throughout South Florida. We're actually going up to Boca Raton in December. In November, we're going to be in Fort Lauderdale. So the idea is to bring together condo-minded types of people, even like Jose, who typically does non-condos, but now you can see because the opportunity is kind of getting in the game. So Jose, going back to First Service, what they did is they came out with their second annual report. They're saying that the average maintenance fee for a high rise in Miami-Dade County, so it's not going to be a lot of suburban stuff. It'll be stuff more near the coast. 7 stories or higher, looking at $1.15 a square foot per month on the maintenance side. Then when you get up to Broward and Palm Beach, you're looking at $1.02 a square foot per month. We ran some calculations. Property taxes are coming in at roughly about 58 cents a square foot per month. So you can see very quickly, you're talking $1.50 a foot or so. No, maybe $1.60, $1.80 a foot or so just to get in the game, Jose. That doesn't include vacancies. That does not include any kind of repairs. That doesn't include property management fee for an individual if that person's renting out for you. It doesn't include real estate commission. And most importantly, Jose, it does not include any kind of debt service. So just by doing that simple number of how much rent can I get versus what's my property tax and what's my maintenance, take a guess what the overall cap rate is greater downtown Miami, which is the biggest condo market in South Florida. And then take a guess what the cap rate is on a vintage condo, which are those that are 30 years or more, and they got to do the milestone inspection. So Jose, what do you look for in a cap rate, which again, capitalization rate? Am I going to make money on this? Is this truly an investment, or am I purely speculating because I want to get that unit I think I'm going to sell in the future? So Jose, what kind of cap rate do you typically look for on your investments? And then I want you to guess what downtown Miami's cap rate is, as well as the vintage units in Miami Beach are.
Whew. I would have to say that the downtown Miami.
No. I want to hear your cap rate expectations first. What are you willing to look at?
Whew. I mean, ideally, an 8-10% is, I think, the norm. I don't know how frequent that is down here.
Okay. Let me lay it out, Jose, and you tell me if I'm wrong, and we'll finish up that question. We just came out with a guide. We're calling it a investability barometer.
Okay.
And what we're doing is we're laying out the cap rates, what we think makes sense, and please push back if necessary. We're saying if your cap rate is 0 to 1.99%, that is uninvestable. Less than 2%, uninvestable. 2% to 3.99%, we are saying is unattractive. And then 4 to 5.99% would be investable. You're not gonna make a lot of money, but it's investable. Then when we go 6 to 7.9%, we would call that attractive. And 8% or more, which is what you're talking about, Jose, we call that pound the table. Pound that table, flip that damn thing over, and run in there and take a shot at it. So you're saying 8%. We're saying our 8% represents pound the table, but we're saying 4% is minimum investable. Anything less than that is not really worth your time unless you're really willing to gamble. Do you see any problems with our layout in terms of how we're evaluating cap rates?
No.
When it comes to residential real estate property?
No. I think you're right on.
Okay. All right. Now, based on us being right on, give me a guesstimate. What do you think Greater Downtown Miami's cap rate is? Again, only based on property tax, maintenance fee, and you minus that from your gross rent.
Maybe a 2 to 3%.
Okay. And then what do you think on vintage units, 30 years or more in Miami Beach? Miami Beach is saddled with all these vintage units. Take a guess what the cap rate would be there.
Maybe 1 to 2.
All right. So Greater Downtown Miami, 0.8%.
Mm.
Miami Beach Vintage, 0.7%. We are deeming them uninvestable across the board. Your thoughts? Are we being too hard on these marketplaces based on the asking prices, the rental prices, and the carrying costs, or are we maybe like right in line?
No, I think you're accurate, because when you look at the taxes, you look at the insurance, you look at the maintenance, I always tell myself, why would somebody buy one of these? It's just the cap rates, the cash flow just a lot of times don't make sense. And that's sometimes, or for the most part, not even including the financing. I don't know, from a strictly cap point of view, I don't think it makes sense, to invest in those. But I think people look for future appreciation, I guess. I don't know. I think they have other goals in mind, but it doesn't make sense from a cap rate. A lot of the properties, when I go to buy them, I look to see if I can keep it. And I end up flipping it because the numbers to hold them just don't make sense.
And that occurrence, that phenomenon, when you go and you buy a place, and Jose, well, let's pause there before we go any further. Why don't you give people an idea of your background? Why don't you give people a general perspective and how long you've been on the ground, and maybe if you could start off with your land business, and then if you could just kind of progress. Obviously, I want you to talk about the time we spent running and gunning during the Great Recession, and then if you could just sort of advance us to kind of what you're doing right now, just so people get a true sense of your reach,
yes,
and your wisdom and your experience.
Right. Well, it's very simple. I'll go chronologically. I mean, I started as a new investor in the South Florida area. I started going to the investor meetings and really just started buying, fixing, and selling, and did that. At the same time, myself and a group of other investors formed the Dade Real Estate Investors Association back in around 1996. So it was a network, a club for people that flip properties. You can go freely network, interact, do business. And I pretty much kind of ran the educational departments on that. We would do the bus trips, we'd get the speakers in to come and speak, etc. And then I progressed into wholesaling. I would fix and sell. Then I would wholesale a couple because there's only so many you can do. And then I also
could you explain? Yeah. Can you explain to the public what do you mean by wholesaling?
Wholesaling is almost like any other business. A retailer, a store buys from a distributor in volume, and that would be like a wholesaler in real estate. So as a wholesaler, I would find a deal, and let's say I'm fixing 3 of them and I can't fix another one. I would find what I call like the Home Depot investors that go in there, swing a hammer, go buy the materials, are going to fix it up and sell it to an end user at retail price. So I would make a wholesale markup, a small markup, sell it to him as is or her, and they would fix up and sell it to the end user, making the lion's share of the profit, let's say, because they're going to be there much longer, doing a lot more work. That's a wholesale. So I did that, and then simultaneously to the people that would buy my properties, I would lend them what we call hard money in the business. That's allows them to go and buy cash terms, not having to deal with the bank, just enough time. It's usually a year loan at a higher interest rate, gives them enough time to buy it, fix it, and either exit out with a sale or refinance with if they're going to hold on to it. So did that and did really good, was getting ready to retire. I was going to join Peter in the good life, but and behold, came the Great Recession.
Nobody saw that coming.
Right.
Nobody saw that coming.
I actually, there were indicators, but like everybody else, I just said it's another wave in the market. It's another cycle. And instead of starting to unload and exit, I basically just kept doing what I was doing, and unfortunately ended up with about 300 properties when the when the you know what hit the fan. And a lot of them were the land, because at that point I was also starting to do lots in Central Florida, like Sebring area, Ocala, Cape Coral, et cetera, et cetera. And what we would do is we would accumulate 100 lots, and then we would do a statewide auction, and we would just auction them all off in a day. And then we'd go out and get another 100 and do the same thing. So the last couple of auctions, between the storms that came and everything else, we could see something was going on, and just things weren't selling. And then the music stopped, and then I was forced to go work with Peter at Condo Vultures. We were doing the condo market arbitrage. I was in the bulk department with the brick